Okay, so thanks Shane for the introduction. Thanks everybody for being here. We're running a little behind, so I'll just jump right in. As Shane mentioned, this is the topic of this report is Measure ULA, which is a real estate transfer tax put in place by popular vote in 2022, went into effect April 1st, 2023. And it is a progressive transfer tax that you can see the details here. A 4% tax initially on sales between $5 and $10 million. For sales $10 million and over, a 5.5% tax. And then those thresholds go up with inflation. So each year that threshold goes up a little bit. So right now, this bottom threshold is closer to $5.15 million or something like that. The sales, everybody pays generally, unless the buyer of the land is a nonprofit housing developer, and the revenues are allocated to support various affordable housing initiatives, ranging from actually building affordable units to tenant assistance, direct aid to tenants, to informational programs to help tenants know about their rights and things like that. About or up to 45% of the revenue is allocated to actually build. So it's a minority, although not by much, by the build. And this, I should say, broadly speaking, this is not an idea that I have a big problem with. I kind of like the idea of progressive real estate transfer taxes. This quote is me circa 2021 in an essay about value capture, basically explaining why a progressive real estate transfer tax is preferable to lots of other ways that we raise money for affordable housing. And what I say there is, and I can go into a little bit more detail about this, but I run out of time. But what the main point I make here is that a lot of the money that local governments can raise has to come from either property or land, right? And that makes it these taxes are wealth taxes. One of the big problems with wealth taxes, there's two big problems with wealth taxes. One of them is that people worry that people's income doesn't keep up with their wealth, right? So the value of your house goes up, your income doesn't go up, suddenly you're hit with a big property tax bill. This is one of the main motivators, rightly or wrongly, behind Proposition 13. The other thing about a wealth tax, and a property tax is no exception, is that it just kind of, the way it's set up is that it seems unfair, right? Because one of the few taxes, wealth taxes are one of the few taxes where the government sets both the rate and the base. Right, when you pay your income tax, the government tells you what your rate is. You're going to pay 22% or something, but the market sets the base. Like you make $70,000 a year, that's your base. For the property tax, the government basically comes to you and says, your tax rate is 4%. Also, we've decided your house is worth $500,000. To a lot of people, that makes it seem like the game is kind of rigged. It's not. The government's doing its best to figure out what your house is worth, but it becomes very controversial. The nice thing about a transfer tax is that it can, if it's designed carefully, get around both these problems, right? You sell the house. When you sell your house, your wealth turns into income, and so you don't have this problem that you have no money. You can use some of the proceeds to pay the tax. Also, because you've sold the house, the market has now set the base. The government isn't estimating how much your house is worth. You've sold it. You just sold it for $800,000. It's worth $800,000. So this is actually a very nice way to do things, given other constraints that we face. The two caveats, though, right, one of which is implicit in this quote and the other of which is not, is that one, the sale has to be for profit. It has to be profitable, right? If you sell your house at a loss, you're not going to be able to take a tax bill with the proceeds because you lost money. And the second one is that you don't want to do this in a way that impedes property development. In a city that has a housing crisis, we need to be building more housing. One of the first things anyone who does any construction has to do is buy land. And so you want to make sure this is not structured in a way that it penalizes people who are trying to sort of help us solve the same problem that the revenue is going to. So when ULA was first proposed, I was not a resident of Los Angeles. I lived in West Hollywood and I didn't pay a ton of attention to it. I looked at it briefly. I saw that it didn't exempt new construction, and I said something like, I wish it would exempt new construction, and then I didn't pay attention. And then it came into effect, and people were sort of worrying about it, and my colleague who I wrote this with, Mark Smith, who's on the Lewis Center's board, but is also much more of an advocate than I am. He runs an organization called the Council of Infill Builders. he was getting increasingly agitated, and he came to me with some graphs that he had put together and said, like, I really think this is screwing up transactions. And so I looked at the graphs and I was intrigued, and I said, okay, well, let's see if we can dig a little deeper. And that's kind of how this was born. And then when it looked like there was actually something to it, maybe in December, I emailed Maddie and Claudia and Shane and said, I think I might have a report on Measure ULA. And Shane wrote back and said, I'm writing a report on Measure ULA. Which is, I don't know what the opposite of a conspiracy is, but when there's two people in the same building who don't know what each other are doing, that's what we had going on.
Inefficiency.
Yes, it's a massive, we are a large state university, and inefficiency is our business. So let me back up a little bit now and just kind of give the context for how I generally think about things like this, which I don't think is I think it's just commonplace in the literature. So there's always a tension when you want to raise money, right? Between when you have a tax, between raising revenue and changing behavior, right? Like that, almost all taxes are going to do some combination of those two things. If you're being a stickler, a pure head tax and a pure hand tax on land value do not change behavior. We don't use those. And so if you're designing a tax, you have to figure out what your main goal is. You want to raise a lot of money, or do you want to get people to do more or less of something? And then design the tax with that in mind. And if the goal is to raise a lot of revenue, which something like Measure ULA, presumably that is the goal, because what we want to do is get a lot of money to help people in different ways who have a hard time affording housing. The mainstream consensus is that a tax should have a broad base and a low rate. And what I mean by that is that the tax should fall on lots of different taxable units, whatever that might be. And it should fall relatively lightly. And the reason for that is that this is sufficiently unnoticeable that it's not worth it for the person being taxed to try and avoid the tax and change their behavior, right? And so if you place a very light tax on gasoline, for instance, even though the rate isn't very high, you'll probably raise a lot of money because people just won't notice it and they'll keep driving and they'll pay. If you put a very high tax on gasoline, people are going to react to that because now driving is a lot more expensive and they'll drive less. You're going to get behavior change, but you're not going to raise as much revenue, right? So that's the kind of balance that you want to strike. And so when you start thinking about, so that raising revenue isn't the only thing you can do with a tax. And when you start thinking about other goals, right? Then you have to start thinking about how to strike this balance, and things get complicated. And that's particularly true when you want a tax to be very progressive. When you want a tax to aim at higher income people or firms or whatever, you have to keep in mind that you're doing two things. You're narrowing the base, and you're also identifying a group of people who have more motivation and more means to avoid the tax. And that doesn't mean you shouldn't tax progressively. It just means that when you do, you have to start keeping in mind different ways people react. This is by now a famous paper by Thomas Piketty and Emmanuel Saez and Stephanie Sancheva about, if you really wanted to tax people at like 80% of the marginal tax rate of 80% of income, like what do you have to think about in terms of how they're actually going to react to it, right? And I won't go into details of this paper, but this is just when you start saying like, well, we don't want to have a broad base, we want to have a narrow base and a high rate, you really have to start anticipating how people's behavior is going to change.
Mike,
yeah.
I'm going to take my moderator prerogative and interrupt sometimes maybe, but like a clarification here. So, with the gas tax, sometimes the point is actually to change behavior.
I'm getting there. Okay. So, so the other, when you start doing this, right, when you start building in taxes that have different rates and higher rates, one of the things that everybody recommends, and we see this in our own income tax, is that you avoid what are called cliffs or notches, right? And these are huge discontinuities in the tax code, where if you just have a small change in your own tax status, your tax bill goes way up, right? There's a reason why if you go from making roughly $45,000 in the United States to making $46,000, and your tax bracket goes up as a result, that new tax bracket only applies to like that last $1,000. If it didn't do that, if you were taxed entirely at the high rate on your new income, you would have a reason not to make more money. Or more likely, you would have a reason to try and hide your new income from the government, right? So the marginal rates minimize these perverse incentives to avoid the tax. And the big takeaway here, right, is that the taxes don't just work because people can afford them, right? That's important. But if you really want the tax to work, you have to design it in a way so that people can't avoid them. And so that otherwise, if you don't do that, you're just going to get a lot of behavior change. Now, sometimes do you want behavior change? Is behavior change always bad? No.
I'm gonna trust you from here on.
Okay. That, you'll regret that. And this depends on the behavior, right? And the big question, the rule of thumb is like, do we have too much or too little of the behavior that's being taxed? And so with something like a gas tax, people sometimes think it's a win-win, right? If people just keep driving, we raise money and we need money. On the other hand, if people start driving less, well, there's a lot of reason to think we drive more than is socially optimal. So that's a win too. Similarly, or to take it even further, if you have a tax on cigarette smoking, there's some people who say the ideal cigarette tax raises no revenue at all. Right? The tax rate is so high, it just makes people stop smoking. And the public health benefits of that are worth way more than any revenue you could raise. On the other hand, if we put a high tax on savings, well, the typical American doesn't save as much. We'd want to be careful then, right? And so what we're talking about when we talk about this balance is we have to think about how bad is the behavior change, and what we would say is that unwanted behavior change is a cost of taxation. In technical terms, it's called excess burden. And so you want, if you're trying to raise revenue, you want to minimize that excess burden, get people to sort of pay the tax and not take steps to avoid it. So with that in mind, let's think about Measure ULA. Measure ULA has a number of attributes that a public finance person would look at and say, it'd probably be better if it didn't have that. It has a narrow base, it has high rates, it has big notches, and these three things together should suggest to us, that it's going to create a fair amount of behavior change. Just to put this, and again, we can think about this just in terms of Measure ULA. We can also think about it in terms of there's a not huge, but fairly consensus-based literature on transfer taxes, and they generally say, yes, they tend to raise revenue, but they also change a lot of behavior. They depress the volume of real estate transactions. This is a well-known paper from about 2012, Ben Dacus, Gil Duranton, and Matthew Turner, looking at a 1% tax that's placed on transactions over $400,000 maybe in Toronto, and they're finding that reduced real estate transactions by about 15%. The usual concern of this kind of thing is that people worry that it reduces residential mobility, that people are less likely to sell their homes. When they're less likely to sell their homes, the labor market doesn't adjust as quickly as it could to changes in macroeconomic conditions and things like that, which in my opinion is a real concern, but not necessarily a gigantic one. You really have to weigh it against what you were using the revenue for and things like that. But this is what the literature usually focuses on. Measure ULA is a little bit different than a lot of the taxes that are studied in the literature, because it has such high rates and because it has such a narrow base, right? And I think it has these high rates and a narrow base in part because it had to get voted in by a majority of the electorate. And it is really useful if you need people to vote for a tax to really assure them you will never pay this tax, right? Most people are never going to sell a $5 million property. And so this was advantageous. And then I think it was very helpful to sort of give it the billing they gave it of like the mansion tax, right? Because like it just, there's sort of, you can tap into some good old fashioned populism. But this is a comparison of real estate transfer taxes across the US, just a handful of them. And I think one thing you see if you look at this is that ULA has the highest bottom rate of all of them at 4%. It has among the highest top rates. Santa Monica's top rate is a little bit larger, and it's sort of tied with San Francisco. It has absolutely the narrowest base. The tax doesn't kick in until you're over $5 million, whereas some of these others apply to all transactions or just transactions over $1 million, et cetera. And when you put that together, and notice that the rate isn't marginal, and most of the, in fairness, most of these don't have marginal rates, Culver City's a real exception. You're gonna get a pretty big notch, right? Which is to say that if you sell a property for $5 million, you don't pay any tax at all. If you sell it for $1 more, you have a $200,000 tax bill, right? And so you have an incentive if you're anywhere near there to not be selling that property. And so, you know, a priori, this suggests there's probably going to be some behavior change that happens. Now, I think there's different ways to think about that behavior change. Now, one thing that I want to come back to, but I'm going to mention right now because it's important, is that this high threshold does matter. It makes it very different than other taxes. The fact that the tax doesn't land on most transactions also means it can't affect most transactions, right? So the kind of thing Gilles de Ranton found in Toronto, where like even just a 1% tax had this big impact, you're not going to find that here, right? Because that tax fell on most of the houses that sold in Toronto. ULA doesn't. So you have some reason to think it's going to a little bit different. The other thing that sometimes comes up when people talk about a real estate transfer tax affecting sales is this objection that's sort of like, well, sellers have to sell. They can't avoid the tax. Like and that's true for some sellers, right? Which is to say, if you're the average homeowner living in a single family house and you get a job in another state, you probably have to sell your house. You probably can't afford to make your move and go buy your next house unless you sell the one you have, and tax or no tax, you're going to sell your house. But that doesn't describe everybody. What if you're a couple of empty nesters and your kids are out of the house and you just feel like your unit's too big? Yeah, I mean, if you're faced with a big tax, like you have a lot of discretion. You could just keep living in the big house. Or if you're a guy who just owns an old commercial building, you could sell it, but you could also invest some money to redo it yourself. And if you're someone who owns a vacation home, someone who owns an office tower, right? And I think it's important to keep in mind that these folks do account for not the majority of people on property for sure, but a substantial minority. And then it's definitely a substantial minority of people who own property over $5 million. Like when you say sellers have to sell, that's true, but the people it's true of, ULA has mostly exempted them because their property just isn't worth $5 million. So there's a reason to think that a pretty sizable share of the people who would pay this tax actually have some discretion to withhold their property from the market. And that's before we even get into all the frickin' shenanigans rich people can get into when they want to avoid a tax. These are just like, so this was a blog that a realtor put out me after this came in. He's like, here's some ideas. If you got a bunch of money and want to hire me, we can avoid the tax. You can set up your house as a tenancy in common. Now you have 2 separate ownerships and you can sell each of them for less than $5 million. You can do a ground lease and hold it for 55 years and then move ownership in the ground lease. How much of this stuff is legal? We'll find out, right? But like the point is, and this, do I find this behavior admirable and pro-social? No, right? But if you're designing a tax aimed at people who have the motivation to do this, you should anticipate it. And I think there's different court decisions about whether like this in particular and the LLC in particular are legal, but people will try to do it if you make it worth their while. And if you levy a high enough tax on the sale, one thing you've inadvertently done is make it worth their while. So, all right, so that's kind of the sort of behavior action. I mean, this is also a way to lead into one other concern I think that popped up when I first started looking at Measure ULA, which is just, might seem obvious, it doesn't just fall on mansions, right? And we just talked about office buildings and commercial buildings and so forth. It's called the mansion tax. But what it really does is it falls on any sale over $5 million, right? And so obviously that could represent like a big windfall for a bunch of people none of us particularly like, right? But it could also be like someone sold an office building that lost value during COVID. Like that's the office that UCLA bought after COVID, and the seller of that building lost about $60 million on it. This happens after COVID, right? The commercial real estate isn't as event. It could also just mean someone has built an apartment and sold it, right? And so a lot of what it's taxing isn't a windfall. And then the last point I'll make is that it's also leaving a lot of windfalls that do happen intact. And what I mean by that is just like the converse of the idea that a high price doesn't necessarily mean a high profit is that a lower price doesn't necessarily mean the profit margin is low. Right, so this is a house we just kind of found at random. I apologize if anyone lives here. This is 732 North Vista Street, kind of in my old neighborhood. Right now it's on the market for $2 million, but I think if you look at the pretty sales here, right? If this sold in 2011 for $940,000 and then sold again in 2019 for 1.7 million, the size didn't change at all. Nobody remodeled it. Nothing happened. Or maybe they fixed up the kitchen. But this is in real terms, adjusted for inflation, a 45% profit. That's a big profit. That probably has not much to do with the owner's effort. That doesn't get taxed, right? Because it's under 5 million. So you're taxing some windfalls and you're leaving some gains that are windfalls off the table, right? So, but that's just a little bit of a digression. Big question here is like, well, so there's reason to think this is going to reduce the volume of high value real estate transactions. Is that really a problem? And remember, the question is, well, when you think about this, do we have too much or too little of the behavior that we're taxing? So we would say, do we have too much or too little turnover in property? And in California, we probably have too little. We have too little because we have Proposition 13. What does Proposition 13 do? It holds your tax rate down as long as you don't sell your house. And so it's a pretty well-established finding in California. This is a great paper by Donawati and Michelle Lloyd, like a while back. You know, people just hold on to their property too long. We have what's called a lock-in effect. So the initial position we start from is that we already don't turn over property enough. And then if you think about what ULA might do, by delaying some transactions or deferring some transactions, excuse me, there's two additional potential problems. The first is it's going to potentially reduce public revenue. And this again goes back to Proposition 13. Under Proposition 13, the main way your house gets reassessed to its market value is it gets sold, right? And so if you prevent a house from being sold or a building from being sold, you sort of prevent some growth in local property tax revenue. And that property tax revenue doesn't just go to the city of LA, right? The city of LA collects about 1/3 of the property tax revenue that comes out of its land. It goes to the LA Unified School District, it goes to the county, it goes to the community colleges, et cetera. The second issue is that property sales are what we call a leading indicator of new development. That it's not the case that most property sales leads new development. It is the case that most new development starts with someone acquiring a property. And Measure ULA, for reasons I'll explain in a moment, makes it harder for developers to acquire sites. Okay, but first let me talk a little bit about this public revenue angle. Very quickly, this is data from the city of LA. Most property most of the time doesn't get reassessed, right? Because most property most of the time doesn't turn over. Of the property that does turn over, it's not very valuable. And so it's certainly a welcome rush to the city's coffers when it gets reassessed, but it doesn't add that much. Properties over $5 million, on the other hand, are a tiny fraction of the property that turns over. They're only 4% of transactions, but they represent in most of the last few years, 41% of the growth in the city's tax base. And so when you don't have one of those turnover, you have a lot of sort of foregone revenue. So one way to think about this trade-off is that when a sale happens under Measure ULA, right, you get this very visible direct deposit into a dedicated fund for affordable housing, which is great. But when a sale is deterred, right, what you don't see is what would be a recurrent stream of revenue, tax revenue that we paid every year, not going up that could have. So that's kind of the fiscal concern. This new construction concern, and Shane has a report that talks about this in much more detail, is that a tax like ULA can make it harder for developers to bid for sites. And the reason for that there's different reasons, but the main one I'm going to focus on is that most new units, multifamily units in the city are high density units. They're, 20, 30, 40, 50 units in a building. And they tend to be financed by equity investors, big pension funds, stuff like that. And it's just a general condition of these financing agreements that as soon as the developers finish the building, they sell it. They got to get out. The equity investors want their cash. So it's that sale, right, after the building is done, is going to be taxed under ULA. And so when the developer goes to buy the land, they have to build in anticipation of paying the tax. And they have to bid by however much that tax is going to be. They have to subtract that from their bid. And the key point is that the tax is on the finished building. Because otherwise you could say to yourself, this is a 5% tax, who cares? Bid for 4% less, 5% less, you can still win a bid. But this is kind of, here's a very simplified version. Let's say there's a parcel in LA that's worth about $6 million. Let's say there's a car wash on it. And a developer wants to buy that site, knock the car wash over, and build an apartment building that's going to be worth about $20 million. Right, and then of course the developer has a 20% profit margin, and that's going to be about $5.2 million, which makes the required sort of proceeds from the sale when the building is finally done. What does the developer have to sell this for to sort of get what their projected money is and pay their equity investor back? It's going to be something like $31.2 million. You can quibble with these numbers, right? The important point is the next row, which is that if whatever this number is, that's what the tax is paid on. Like it's 5.5% of that has to be subtracted from the bid up front, right? And that means you're not bidding 4% less, you're bidding almost 30% less. And so now you're not that competitive. Would this matter a lot if all the land in LA was empty? No, the land values would just fall. But like, someone could always come in and say like, no, I just want to buy the car wash, right? Pay $6 million and change for it, and they're going to be a more competitive bidder. So that the point here, and again, this is a very simplified thing, is just that even if a transaction does occur, because of this sort of differential cost, it may not be to a developer. Okay, so the upshot is, if ULA is reducing high-end real estate sales, it could be undermining both local public finance and housing development, but we have to figure out if in fact it's doing that. And so that's kind of what the empirical part of this study was. We got some real estate transaction data, assessor data that we got from a company called Commonwealth Land and Title. It's about 338,000 sales from January to January 2020, December 2024. In addition to the sale price, it shows the date and location, the size of the building and the parcel, tax status, et cetera, et cetera. And we use these to kind of identify sales that would be over the ULA threshold, that were in LA and not in LA, and that occurred after ULA began. And so with that, we could sort of start to put together our research approach, which is called a difference in difference estimation. And the difficulty, I think, when people were initially from the beginning saying, oh, ULA is killing the real estate business, is that was hard to tell because lots of things were going up, right? You had interest rates going up, you had construction costs going up, and so on and so forth. There are lots of different reasons why real estate activity in Los Angeles was falling. And so just looking at the fact that ULA started and then real estate activity fell is not conclusive, right? But the nice thing about ULA is that it offers a sort of natural experiment in that it doesn't apply to sales above the threshold before April 1st. It applies only to sales above the threshold in the city of LA after for April 1st. It only applies in the city of LA, and it doesn't apply in the rest of the county. If you put that together, you get what we call sort of a before and after within and without design, or sort of a quasi-experimental design. That basically, what's happening in LA is sort of a treated group, and the rest of the county functions as kind of a control group. And you can hold constant lots of things that otherwise might confound the analysis, right? LA and the cities around it, they have the same climate. They have the same general labor market, the same general housing market, et cetera, et cetera. And so this controls away most, not all, it's not a pure experiment, problematic variation. And so if you set up a regression this way, you can, under some circumstance, get a causal inference. And so the assumptions that you have to fill for this to be a true causal estimate are that the treatment and control groups had common trends beforehand, which LA, and I'll show you some graphs in a moment, LA and its surrounding cities more or less did. That the market doesn't anticipate the intervention, that basically means that you can't have people realizing well before ULA started that it was going to happen, and then they just fold it into their normal business practices. And the graph, of course, will suggest they don't do that as well. That there's no simultaneous similar interventions. This isn't quite there. During this time, both Culver City and Santa Monica also put transfer taxes in place. So we have to control for those in different ways in our regressions, which we do. And then the last one, which is that there's not spillovers, which is to say that that the putting the tax in place in Los Angeles doesn't causally change behavior outside the city of Los Angeles. This one's probably violated. It's probably violated in two ways. One is temporally, which is to say that like right before the tax goes into place, a lot of people are going to rush to sell their property. And what's that going to do? It's going to artificially make the level of activity before the threshold too high. It's probably going to create a little bit of a trough afterwards. And we control for that in our regressions. The second one that we don't really control for in the regressions is this question of just like, even aside from the rush to sell, would the tax affect buying and selling across borders? And my sense is, and you guys can argue with me about this if you like, probably, but probably not to a huge extent, right? So there's two ways you could imagine it happening. One, which I think is slightly more plausible, is that because if in fact this reduces the amount of properties that go on sale in LA, people who would have been trading partners of the people selling those properties in other parts of the city also don't put their properties on the market. Now, that's way more likely if we're just talking about single family homes and lower cost single family homes than if we're talking about things like manufacturing buildings and towers and stuff like that. But if that's the case, then any estimate we have is going to be a little bit lower than it should be. Conversely, you could say, well, someone coming to LA because of ULA isn't going to buy there because there's not enough stuff on the market. And so they're going to go buy in Burbank instead. And that's going to artificially increase the amount of transactions happening in Burbank. This isn't impossible, but there's a kind of an extra step in there, which I'm happy to talk about in the Q&A, which is just like, not just that you went to Burbank to buy a house and you might have bought one in LA or to buy a commercial building or whatever, but that enough people did that it actually raised the price in that other city enough that more stuff came on the market, right? And if that doesn't happen, I think that's probably neither of these I think are too huge, and if they exist, they probably cancel each other out. So the bigger one is this one, which we have to control for explicitly. Let me just really show you a couple of graphs, and then show you the regressions. What the graphs show are kind of visible evidence of these notches I talked about. And you can have notches of two kinds. One can be temporal, like a timing-based notch, like when the tax comes in, and the other can be a price-based notch around the sort of threshold of $5 million. And so this is real estate transactions that occurred below the ULA threshold in LA County, all property types. And here's where ULA began. And what you see is that they track each other pretty well. That's that sort of common trend. And then if you look at sales that are above the threshold, the common trend is, there's a lot more volatility in these higher end sales. The common trend is kind of there, right? It's more or less there until you get to ULA, and then you see a big drop off and a gap develop between the two. Again, this is just a graph, but that's what we would call a difference in difference, right? And again, I'm sure everybody can notice this. This is the strategic behavior, the rush to sell before. And so this is actually reassuring. It shows us that the market did not anticipate this reaction. So one of the assumptions of the difference in difference holds, but of course it can be problematic because it suggests a spillover. And if you just sort of break this down by other property types, I'm not going to dwell on this, you see roughly the same sort of pattern, right? Which is there's a big difference when you're talking about properties over the threshold. And then you can look at sort of a price notch, right? And so rather than look temporally, you can just say, well, what's the distribution of sales prices before ULA kicks in the city of Los Angeles? This is the $5 million sales notch. There doesn't seem to be any real pattern here. Now look at the distribution of prices after ULA kicks in, and you've got a notch, right?
Yeah.
And then you go to the other parts of the county where ULA wasn't there, nothing happens. That's a difference in difference. Okay, so does it hold up when we do a regression? Remember, our expectation is that for most transactions, this isn't going to show up. Most transactions aren't affected by it. So just a very quick one, difference in difference, super simple. And what you're looking at is this coefficient called post times treatment. That's the unique interaction of the date being after ULA kicks in. And in this regression, a sale being above $5 million and in the city of Los Angeles. And it's broken down by all sales, single family residential, commercial, industrial, manufacturing. And what you see is there's no, and these are semi-elasticity. So if it's below 1, it's sort of a negative effect. But for all sales and for single family residential, that's negative. There's no significance. That's not surprising. Remember, most single family homes aren't affected by this. It's like 3% of them or something like that. Get into commercial and industrial and multifamily residential, and you see a bigger effect that is statistically significant. There's all sorts of reasons, not that you would have to take this with a grain of salt. You'll notice there's only, these are done by quarter. There's only about 40 observations. This regression is probably underpowered. It is reassuring though to see that like it does pop up. So to make this a little bit more robust, we divided everything into sort of by zip code by month transactions, ran a different kind of regression called the quasi-Poisson. I'm happy to talk at length about this in the Q&A, but the main thing that you see is, again, if you just do all transactions, it's not statistically significant. You have one weird result where it says that it actually is positive and significant. That goes away once you control for individual zip codes and things like that. And you get a much more consistent result, which says it's negative, but it doesn't, not much shows up. If you now focus though on just the other property, the non-single family property, which again makes up a much larger share of these $5 million plus transactions, you see something a little bit different, which is that depending on how you estimate it, with different sort of controls for individual zip codes, individual year and month, the city you're in, et cetera, you get something between a 15% and 7% reduction by month in sales relative to a counterfactual where you didn't have the tax. And you see here on this bottom row, these last two estimates, we just cut out the months right before and right after the tax went in to sort of control for that rush to sell. If you think about what this means, say, okay, well, this is somewhere between a 7 and 15% reduction per month. That basically over the first 2 years of the tax is about a 30 to 50% reduction in the volume of transactions. And so that's a quantity regression. The other way to do this is just to say, well, what are the odds that if a transaction does occur, it actually occurs above that $5 million threshold? And these are a little bit, for tractability reasons, easier regressions to run. And there's like no ambiguity here at all. These are odds ratios. So to understand what they mean, you just take this coefficient and subtract it from 1. And that's the percent reduction in the odds that a transaction is over the threshold. So what you see is that the relevant coefficient suggests it's basically between 45 and 50% less likely in LA after Measure ULA that a real estate transaction happens over the threshold. And this is robust to all sorts of different controls, right? Controlling for transfer taxes in other cities, different attributes of the site and building, for residential buildings, an explicit bedroom count, a year trend, maybe the transactions are growing over time, controls for every single zip code, and again, controlling for the notch. Odds ratios aren't probabilities, but they're pretty close. And if you work out the probability, basically it's about 50% less likely now that a transaction in LA will be over that threshold. So the summary, 30-50% reduction in transaction volume, 45 to 55% reduction in the probability of a transaction being over a threshold. We took that and plugged it back into the sort of data we had on net taxable value. Conservatively, that's in the first year, 18 months, a $25 million reduction in property tax revenue. So, and let me emphasize again, like, this is not some randomized controlled trial. Like, this is probably off somewhere here or there. We think it's pretty conservative, but the way we put it in the report is like this, you can quibble, but I think a fair reading of the evidence suggests there's at least some reason to be concerned. So what can be done? When this report came out, I definitely got emails from various people that are like, finally, and now we can abolish this tax. And I was like, that is exactly not what I'm saying. In fact, it says in the thing, do not abolish this tax. I think there's two different ways to think about reform. One is like, what could you do to ULA right now that would be, in the grand scheme of things, relatively easy to do? One of those things would be just like, make it a true mansion tax. It's probably what the voters thought they were getting. Just say it applies to single family homes, right? Another one, which is, I think something that Shane has talked about, and I agree with as well, is just exempt any sales that lead to new construction. You know, if 5 years after the sale, you got a building permit, you get your tax refunded or something like that. And then this would do roughly the same thing. You could phrase the exemption as, well, if your property's been reassessed relatively recently, you don't pay the tax. And the idea behind this is that it's properties that really haven't been reassessed in a long time that tend to have the biggest windfalls. And if you did this, you would probably just by construction also exempt new development, but also sort of prevent unfortunate situations where someone might pay the tax on a business loss or something like that. If you were to sort of say, well, what if we wanted to do this all over again, just as an intellectual exercise, or if like Long Beach was thinking about doing a tax like this, you'd want to think about stuff like that as well. But then I would say also, if you were doing this over again, you should have marginal tax rates to prevent some of this strategic behavior. If you worried that this would cost you revenue, which is a fair worry if you do marginal tax rates, you could have another lower bracket, right? I mean, I think you really want to, I think one of the lessons of Measure ULA is there really is a trade-off between sort of like just going after the highest value transactions and getting like a steady stream of non-volatile revenue. And if you really want that revenue to help people who need rental assistance and things like that, I do think you want to err closer to having a broader tax with a lower rate. I understand the political obstacles to that, right? I understand why they did ULA the way they did.
Mike, I'm going to ask you a couple of questions and then turn it over to the audience. If you could go back to the last slide, actually.
Yeah.
On the recommendations, do you have a sense for what the cost of those first three would be? I could say that the second one, we looked at if you were to exempt the sales of multifamily, commercial, industrial properties, if they were sold within 15 years of construction, and whether you were looking before ULA was in place, so assuming it had been in place but didn't change behavior, and after, multifamily that's 15 years or less raises 6 to 8% of revenues, not a whole lot. Commercial and industrial combined was about 5% in both periods. Do you have a sense for the mansion tax and the reassessment one?
I think the reassessment one is just going to look a lot like the new construction one. So I would guess that the magnitude would be similar. The mansion tax one, I don't know. I think, you know, and you'd want to know, right? I mean, I think one of the appealing things in the short term about the calculation you and Jason have done is that it really does drive home the fact that if you exempted new construction, you'd get almost all the good stuff you're getting with the ULA revenue right now, and just sort of putting to bed this risk of collateral damage, right? And that's what you want. You want to just sort of like close what basically an unfortunate loophole or something in the tax, but preserve the revenue. So if it turned out that flipping it to a mansion tax knocked the revenue down 40% or something, I think you'd want to revisit.
Yeah.
Yeah.
And I do think that's about what we were talking about. I think somewhere between half and 2/3 of revenue comes from single family of any age, mostly older,
Yeah.
older single family as well.
Yeah.
So it is a big effect, but
But I think the second two are comparable in
Mhm.
the amount, you probably 8, 10, 12% of your revenue or something.
this is just something I, read a draft of your report before it was finished, and I have not read through it again because that would be crazy.
Yeah, absolutely.
But something that occurred to me as you were talking about the property tax effects was, this tax is presumably lowering what people are paying, and so it's setting a 4% or a 5.5% lower basis.
Yeah.
That the property tax is then, applied to in perpetuity until it's reassessed at some
Yeah.
point. Did you factor that in or consider that?
No, we were super conservative with that property tax number. We ran it by people at the assessor's office. We actually ran a much larger number past them, and they were like, yeah, that looks right. And then I didn't want to put it in the report. I just thought I thought we were I wanted to make the most conservative assumptions. And so this was purely an exercise of, if you didn't have 50% of those 5 million transactions, what's that look like right then? Obviously, it's gonna, one, compound.
Yeah, right.
But the other thing that's gonna happen, to your point, is that eventually, especially people who own more valuable properties are gonna go to the assessor and has to be written down. Right? They're gonna say, like, you're valuing me at this, but like I got a 5% tax or looming over me. My property isn't worth that much. It's hard to say how many people will do that, at what rate. It's hard to say the rate at which the assessor might approve those requests. But yeah, you would imagine that quietly it could lower assessed values across the city.
Well, I'm just talking about like the actual sale price lowering because
Yeah.
of the tax.
That,
Well,
yeah,
because that's not
right.
the value of the property
Yeah.
presumably, or maybe it is. Maybe maybe that's factored into the whole.
Yeah, I mean,
Right.
that is a little bit of a black box to me, but I do
I'm
think,
guessing it's separate because it is a
Yeah.
tax. It's not.
The closing cost.
yeah.
So it's.
Okay.
Yeah, I think that you would have to, for it to show up, someone would have to show up and say, I'm petitioning because XYZ this tax and so forth. And again, it's hard to say how amenable an assessor would be, but I think the general point is that it's a conservative estimate.
Got it. All right, last one for me. So we've both presented our reports now
Yes.
and shared it in various places, and you've heard from the people who really, are excited about this and want to go much further than you're proposing with reform. And we've also heard from people who are not excited about it and don't want to change anything. And so we've heard a lot of different arguments. One that I think is, at least intuitively appealing, or it sounds plausible, is, it's been 2 years. Is it not too early to be sure of what the effects of Measure ULA are on transactions? The charts you have there, they do show, like, it seems like maybe there's some narrowing of the
Yeah.
gap over time. And so what's your response to that concern that, this is too early to be jumping to conclusions or reaching conclusions about the effects of the tax?
Yeah, I mean, I guess there's a few. Well, if the first is just like, yeah, one never knows. But I do think that even if the transactions recovered, and no one has really laid out a mechanism by which the transactions would recover. They're just like, they're gonna recover. And maybe they will, but if the transactions recovered, that doesn't necessarily solve the problem of new development, right? Because you can have a situation where these properties are selling, but where, because of ULA, people who want to buy to build are still systematically displaced.
Mhm.
Right, and that's kind of the bigger problem to me. It's a big deal if we lose property tax revenue too, but like this, the region really needs housing. The other, well, then one empirical thing I would say, because yes, we were hearing from someone yesterday who was like, well, what happens if you just look at the last 6 months? And that, it just hasn't changed that much. This is just the last 6 months, and there's still a big
Mhm.
bunch, and there's still a big drop off. But the third thing I'd say is just like, well, all right, if 2 years isn't the right time, when is the right time? Right, there's like an old joke that government contractors used to make about like the two stages to like a Pentagon project, which were too early to tell and too late to stop. Like, you can always set things up in such a way that it's never the right time to figure out if you should do something. And yeah, no, I mean, like, if you have a reason why 2 years, like a specific reason why 2 years is too early, like, I'm open to hearing it. But like, if you're just kind of, but my curiosity would be like, do we have to wait 2 years to see if Trump's tariffs work? Right, because what he's saying is like, just get through the pain and we're all gonna be rich. And so it's, yeah, I'm open to arguments
Well,
about it.
and I do think that your intro here, kind of explaining why we would expect the effects that we see,
Yeah,
explains a lot of it too, and the people who, are raising these concerns probably have not read the report and definitely have not seen this presentation, so I think they.
yeah. Well, the other thing too is just like we've had Proposition 13 for a long time now, and it has had a persistent effect on depressing turnover.
Yeah.
And so there's no reason, there's a lot of reason to think this will continue, even if it attenuates a little bit, for sure. I can't rule that out.
Yeah.
But yeah.
All right, questions from the audience? Brian?
I have 3 questions. I think they're all really quick.
Okay.
One of them is, you're saying the marginal rate, you're talking about the benefits of a broad base.
Yeah.
Would you suggest something like, starting a 0.5% on all transactions for the first 500,000 and gradually stepping up? Would that solve some of those issues? Is that kind of what you have in mind?
Yeah.
That's one. I'll give you all
Okay,
three.
okay, give me all three.
The second one is, I haven't spent much time around developers, but when I have, the conversations come up about the scandalous sort of real estate industry and their extraction of 6% on 5% on sales.
Yeah.
That I think has a lot of the effects that you're describing here in terms of discouraging turnover. And especially for higher end transactions where it's really hard to argue with why that whole industry exists to, it described as rent seeking.
Yeah.
And could that be addressed as a way of transferring some of the money that goes to real estate transactions to affordable housing?
Mhm.
And the third is, what would happen under sort of a Georgia's property tax model of what you described?
Yeah, so all right, with respect to the first one, yes, I mean, you may not want to go down quite so low, right? You might want to think about exemptions for first-time home buyers or houses that are really pretty inexpensive, but I think that if you wanted to really maximize revenue, you would have, yeah, like the base would be broader, which means the threshold would be lower, and then it could escalate as you climbed up through the ranks, again, sort of being careful about what exactly you wanted to do, because you always are still going to run the risk to some extent of at the top end, and sometimes you just have to swallow this and just say, look, we're going to put some resources into enforcement of a very high-end properties trying to figure out ways to get around.
Alex Fish, who wrote the Culver City law, which has a $1.5 million bottom threshold, he has said that like that lower threshold, the single family homes and so forth that sell, that's like the base for the tax that's just consistent and they can kind of expect within a range year to year. And then when they get the like $300 million Apple building or whatever that sells, then it's just like these windfalls that they can do other things with, but they get this predictable source. I think it's probably less of an issue in a city as big as Los Angeles, where
Yeah,
you're gonna have a lot of large sales regardless of where the market's at, but you're gonna have more volatility probably.
Right. With respect to the issue of like brokers' fees and stuff, Mott knows a lot more about this, having built many buildings and bought and sold many buildings, but it does seem like with, according to him, these bigger sort of commercial transactions, those are much more negotiable. So that like, whereas, when you go and buy and sell your house, the realtor is just like, I'm sorry, I'm taking whatever percent. If you're brokering an office building downtown, I'm just passing on what my co-authors recounts, that actually can be kind of talked down a little bit. And so it becomes a little bit less of a thing. I think that if you had a transfer tax that really did make sure you weren't taxing effort, right? That you weren't sort of saying like, oh, I'm taxing the future value of, the 10 stories you built on this land, and also that didn't tax a business loss, you'd have something close to a Georgist look, right? Because if you look at sort of that single family home I showed, 732 North Vista, the same exact property that was built in 1923 in terms of square footage, and I'm sure they've gussied up the interior and stuff, but most of that 50% gain that happened in those 8 years was social value. Right, it was less a product of the owner's effort and more a fact that LA's economy took off, that the work of lots of other people, and if you adopt a Henry George style lens, it is appropriate for the government to take some of that, if it's sort of a social value, and put it toward a social use. So that's why, as that slide I showed at the beginning, I'm generally kind of predisposed to taxes like this, sort of conditional on how they're designed.
You mentioned controlling for like the strategic, like. Prior to the enactment.
That rush to sell,
Yeah,
yeah.
I was wondering if. There was a way to like control for, people anticipating like legal challenges and just waiting out to see if it'll stick, and then if. That capital still exists, they're still wanting to do transactions, are they just moving it down into sub $5 million property transactions?
Yeah, those are good questions. I think the waiting it out, I think there's two ways to think about that. The last 6 or 7 months of our data, that's the time period when the last challenge was defeated. I know that like the Howard Jarvis people are continuing to wage it, they've lost 3 times, but 4th time's the charm. But I think that the reasonable ones people thought might work, that we have like 7 months or so of data where that was gone. The other thing to keep in mind is that during the time that the challenges were happening, what brokers and so forth were mostly telling clients was not don't sell. Right? That's like directly against their interests. They were saying things like sell and like keep all the paperwork, because when this legal challenge works, you're gonna get your money back. I don't know that people were taking that advice, right? But like the idea that there was sort of a concerted withholding as part of a strategy, I think most of the people in the business, as opposed to people who just own the property, they just wanted to keep their fees rolling, right? So they're just like, no, sell, it's gonna work itself out. And in terms of where some, the question is, were some properties just getting pushed over the threshold? Like if you had a 5.1 million, is there 4.9?
Like the people conducting transactions in that one, are they just now doing more smaller?
Oh, like if you're a broker, you mean?
Yeah.
I mean,
Or like
probably-
investing if you are like an
If you
investor,
had,
like
if you had like
going
$20
for a
million
different market.
for a property and you're like, well, now I don't want to pay an extra.
Oh,
whatever. Now
yeah,
it's
I mean,
force
that
it.
I don't know, right? I mean, so you could imagine different reactions, probably depending on what that person really saw as appealing in the particular property in LA they might have invested in. If there's a worthwhile substitute in one of the other cities, they might do that. They might be convinced to do smaller properties. They might have bought something in Chicago, right? I mean, it's just kind of.
if you had like $50 million to invest though, you'd have to find 10 times more properties or more to invest that same amount of money in Los Angeles still under that threshold. And so the idea that there's gonna be all these additional
Oh, yeah,
properties to buy on the market, I don't think would.
I didn't interpret the question that way.
Okay.
I don't think it would be enough to like compensate for what we're seeing. I just, in general, like what someone might do if they had once been planning to sell a property in LA and decided not to, like that probably varies a lot by person to person. My guess.
So there's 2 different lenses through which one can look at all of this. One is the lens of housing, affordable housing, and the housing market. The other is the lens of the fiscus of the city. So the first question is where the momentum from this came from. Was it a fiscal momentum or was it a housing momentum? Second question, linked, how important are this class of taxes for the fiscal base of the city? And then the third becomes a comment.
Okay.
Given that, is it plausible that this is a success story? You had to get something through the voters. So you do something populist and then you fine tune, and that's what's going on.
Okay, yeah, so what was the first one again?
The first one is where the momentum came from.
Oh, so the momentum came from a group, they're now going by United to House LA, but they've been around for a while. And they've mobilized successfully around different initiatives over time. And it's kind of a coalition of, the really big player is organized labor, SEIU. And then the United Way, and then a bunch of groups that might kind of go by the broad rubric of like housing justice groups.
And nonprofit.
And
affordable
yes,
housing
excuse me, and
builders.
nonprofit affordable housing builders, yes. So that's kind of where the impetus came from. And some of the people involved in that have written very detailed accounts of how they came up with it, what they did, and things like that. And I would say that in terms of what a tax like this means for LA's fiscal base, I mean, there's two ways to look at it. One argument is just like not much, right? Because this is just totally earmarked revenue, right? It can only be, the other, I mean, a more realistic thing is just like, well, money mingles. Hopefully LA was going to spend some money on tenant assistance if it didn't have this. And so it's at least sort of freeing up some revenue because now it has dedicated stream to do that. Is it a success story politically? Absolutely. And yeah, like I don't minimize the fact that it's hard to get the voters to vote for a tax, and they did it. And I think that, you know, without putting words in anyone's mouth, I think that's kind of the way a lot of the people who designed and campaigned for it look at it. It's like, this is kind of an amazing thing we did. And you know, and I think from a political perspective, that's absolutely right. It is written in such a way that makes it very hard to fine tune. That we went to, or I didn't because I was a West Hollywood resident, but Angelinos went to the ballot and voted on a sort of 3 or 4 sentence proposition. The law itself is over 30 pages long. And in that law are provisions that basically dramatically limit the city council's ability to amend it. So it sort of ruled out the possibility of fine tuning. I mean, this is something Californians do with their direct democracy stuff, is like they just assume they've written the perfect law and we voted in. And it's like not every state does that. Like when Massachusetts passed its version of Proposition 13, you can't do that in Massachusetts. The state legislature can always amend things that the voters pass. And the state legislature looked at Proposition 2.5 and said, oh, this part's going to be a disaster. And they amended it. And they're allowed to do that. They didn't go against the spirit of it, but they fixed it. That's illegal with ULA. So political victory, yes. Now's the time for fine tuning, sort of written out of the law.
Yeah, the state can step in, and there's a bill in the legislature right now that is, you know, the details are being worked out. But, you know,
Yeah.
it's also, nothing has passed yet, and so there's these proposals to change things, and maybe none of it will come about, and so it
Nothing
would
is,
have been a
yeah.
failure in that regard too. But I also just kind of feel like you shouldn't have to endure the effects that, you know, what we found is it's reducing multifamily production by at least 2,000 units a year. Probably 200 of those are deed restricted affordable units. That's a big cost to pay just to like figure out maybe we should do something and then to do it.
And it's like unfortunate, you know, I'm a fan of state preemption, but it is unfortunate every time we have to use it because it is kind of heavy-handed. Jessica.
So talking about success and Bill's, you could say the success of housing construction partners and the coalition that maybe are going to build more prevailing wage housing or something like that. But when it comes to the fact that the goal was to build more affordable housing and your analysis, and it seems like even on that motion of deed restricted housing, it might be doing more harm than good. Like, have you guys do you share any responses you've gotten from people in the coalition like that seem like kind of the flavor of what people are saying when specifically about that fact, about the goal of being to build deed restricted affordable housing?
Well, I've learned that Shane is an evil person.
That was like he was talking about conspiracies earlier.
They've always probably considered me,
Yours is the more evil one.
but yeah, but they never trusted me.
Yeah.
More seriously, that our report is very careful to do this analysis on the assumption that everything the money is being used for is being used well, right? And I think that's the right way to approach it, which is to say, like, look, you can get whatever you think these benefits are, you can get 85 to 90% of them and just fix these problems. There's another, I think, conversation to be had, which is not what we focused on, but that I think that sort of sentence that gets attached to Shane's report about how this money actually funds less affordable housing than it kills. That opens the door to like, well, and it's a broader issue than Measure ULA. How good are we actually at building this stuff? Right? I mean, it just takes us a lot of money to build a single unit of affordable housing. And at what point are we raising, I'm being extreme here, right? But raising money just to put it on the bonfire. And I think that's a different conversation. But I do think I will say, right, that like when people say things like, we're building this many units and creating 10,000 union wage jobs. And this is nothing against the ULA people. This is something Brian and people at ITS have talked about for a long time. Like, you can't say both of those, right? Because one of them is the cost of the other, right? Like, it's like the jobs are a cost of the housing. And so if you wanted to create lots of union wage jobs, you could amend ULA to say, we are not building this housing using any power tools at all. Right, and you would have an absolute amazing job machine, right? But if the housing is important, then it should be important to us to build it as quickly and as cheaply as we can. And so I think there is a little bit of just broader confusion about what we're actually trying to do when we say we're addressing the housing crisis.
When it comes to the data, you're using transaction data, and I could theoretically see a world where you could see that gap narrow, but it may not actually affect only housing production, but there could be other uses or different things for it or something. I'm just curious if people started, like, I looked at permit data in Santa Monica and it's been dropping off a bit. If we started to look at permit data, like people holding permits. And
Our report does look at that.
Yeah,
That's where we get
that's-
the estimates.
yeah.
And so we're specifically looking at parcels that we consider to have like high redevelopment potential, the right zoning.
So
limited,
you're in Shane's blind spot.
I know.
All right, and then I think you have to be the last question though, because we have a
Okay.
class. Yeah.
It's a hypothetical, but I know there are groups that are interested in condo liability reform
Yes.
or any other policy measures that would unlock condo development. And when I think about the future of ULA intersecting with that, I think of a very different future than the people who passed it intended. Could you comment? Have you thought about this?
I haven't actually. It's a great point. What do you think about it?
Well, an airspace map becomes something that you're willing to pay 5% of your price to get. And
Yeah.
then, so as soon as, if that happens, as soon as interest rates go down, we have a lot of condo development.
I mean, let me just say this to close, and then, I think this is part of a broader issue, which sometimes happens, which is just like you get a bunch of like-minded people in a room and they write a law. And it's possible that they write the perfect law. But it's possible also that like it would have been better if there's a few other people in the room who have different perspectives on things. And like I will be the last person to say we have like a perfect state legislature. But one of the nice things about going through the legislative process is that someone does pop up and say things like, I work on condo defect reform. What are you doing here? Right. And what happened in this is the law came out fully formed. They got the signatures for it. And then it was like, you just vote that up or down. And if they haven't considered some things, then the risk is you're stuck with them. And I think that's a great point. I hadn't thought of it, but that might be one of the things you're stuck with. It's a lot of
So
content.
I call it the apartment tax. And the condo subsidy.
There is still the fact that like the bank is gonna lend to you as though you're gonna pay the tax, because if they foreclose, they need to sell the whole building. They're not gonna sell it as individual, airspace lots.
Yeah.
So I think that will be to some extent overcome in the long run, but that is an issue right now. Just getting financing.
Just getting the upfront financing to build it. Yeah. All right. Thanks, everybody.